Hey, what's up, guys? Sam here, and I'll be doing the free video for Friday, March 17th, 2023. So, as usual, I just finished doing the premium video for the fine folks in the gold room, and we looked at everything as we usually do, and maybe a little bit more. This time we actually looked at things like the yen and the Aussie. We looked at Deutsche Bank, we looked at the 2-year, we looked at VIX, and I'm just going to kind of give you guys a quick crash course on what we did. Right, going into next week, anything can happen in this spot where we are. You have a little bit of a credit event potentially starting in Europe. I don't so much care about Silicon Valley Bank. That's a different little animal, but Credit Suisse is quite important, and the potential for European bank contagion is quite high. So that's the bear case, of course. The bull case is that the central banks know this and they're going to save the world. So let's look at the chart, see if we can make sense of it. We're just going to do this one super quick, but we have a lot to look at, so let's dive in. So the SPY here continues to have this bear structure, right? You have the 50, which is the blue line, still sloping lower. You're below the VWAP, which is the dotted line. You're below the weekly 21, and that acted as resistance. The squeeze continues to develop in a bearish fashion. This continues to be bearishly positioned where the red is above the green. And then to top it all off, you have a mid-level double sell signal, which is the worst possible signal you can have on this indicator, is the mid-level red arrows. So that all still says bearish. The structure is bearish. The momentum indicators are bearish. So that all says bearish for now. Things could potentially flip above 396, but at least for now, as it sits going into next week, that is a bearish structure. On the daily chart, you're below the 200, you're below the 21, you're below the 50, you're below the VWAP. So you can see all the moving averages here, white, green, blue, and red, are acting as a little bit of a wall. You have a bear structure here. You have nothing but sell signals here. You do have decent support, maybe more than decent, at 375, but below there, watch out. So next week, the bulls have to break here, right between 396 to about 400. They have to get above that. The bears are going to be looking to target 375 as their next level. And if they can get below that, well, they'll get paid rather handsomely. Let's look at the IWM. We're going to quickly look at all four indices and see if you can spot the odd man out. So we'll do this one quick. The structure, bearish, squeeze firing short. This is fully bearish, more bearish than the SPY. You have a mid-level sell there. So that tells me it's not even oversold on a weekly time frame. You do have decent support here at 170, right? And that is holding, but you have the same problem as everything else. Below there, you have a little bit of a gap. It'll be about $7.50 to the next support level, which is 162. So the bulls here do have to continue to hold 170, even though they're facing a lot of pressure to the downside. This is obviously the worst index because it contains all the small banks and it contains all the unprofitable companies. So I would still avoid this because there's no need to catch a knife. We'll look at the next index after this one, and there's really only one place to be. So the Dow is next. Again, the Dow looks just like everything else. You've had about 1, 2, 3, 4, 5, 6. This will be the sixth close underneath the daily 200 right here. Down sloping 21, down sloping 50, below the VWAP, nothing but sell signals. This is bearish. You have a squeeze that's building, but it's building in a very bearish fashion. This is bearish as well, and you have active thrust lower on the high-low pro. So all three of these indices that we've looked at, the SPY, the IWM, and now the Dow, are all telling us one thing. So there's consistency there. This is where it gets fun. The QQQ. Because the QQQ says, what are you guys talking about? I don't see a problem. You guys are all chicken littles, and I'm going to break out. So here on the QQQ, it's a completely different ball game. You're above the 21, you're above the 50, you're above the 200, and you're above the VWAP. Your squeeze is firing long. You have a positive cross, not a very strong one, but I have to give it credit, it is bullish, and you have a mid-level buy here. meaning that it never came back to the middle, gave you a green arrow, and up it goes. This is actually the strongest signal the indicator is capable of. On the weekly chart, you're above all the moving averages as well. Huge weekly volume. You had a bearish engulfing candle last week on big volume, and you got a bullish engulfing candle this week on a bigger volume, which is really phenomenal. This is still out of whack, so when that's out of whack, I would say that's neutral, because the green line is sloping up, the red line is sloping down, and the red is on top. When this is neutral, you then look at the lower indicator to get your clues. And even though this looks like a bad signal, it's actually a really strong signal to the upside. Because when you get an up signal and then a down signal immediately afterwards, that really is like whiplash. So this would be kind of the example where you get an up and then a down, and that creates whiplash. Here you got a down and then an up, and there is potential this could create whiplash to the upside. So the only thing I have any interest in trading would be to continue trading tech. And the reason being is because bonds are going up really, really quickly. It's like the death of the inflation trade in the near term. The inflation trade may come back, but it's going to require the Fed and other central banks to print a lot of money, which they haven't done yet, and they won't do until things get worse. So in that modality, with bonds rallying super hard, you don't want to be long anything inflationary. You don't want to be long banks, industrials, energy, things like that. And you want to stay long mega cap tech. That's just kind of the game plan. So Microsoft, Apple, Nvidia, semiconductors, things like that. So let's take a quick look at let's take a look at two things we never look at, and then we'll call it a video. So two things that I've been watching as an internal is the 2-year. And you'll note the 2-year here is having kind of a historically unprecedented move. Like this is just, this is moving like Bitcoin, but it's actually just the 2-year note, which is pretty wild stuff. As long as this continues to go higher, this is going to put pressure on the market, because essentially the only reason this is going higher on very big volume, mind you, is because of fear. So take a look at this pattern right here. You have like a big spike higher and then really violent chop up and down. And then next we're going to take a look at the VIX futures, and you're going to see the same thing. So clearly, at least in this moment in time, the 2-year and the VIX futures are basically in lockstep. So as the 2-year goes down in rates, or as the 2-year rallies and rates come down, the market's actually interpreting that as deflationary and probably not great. You have the big spike and then really violent chop here in the VIX. So those two things tie together. The one to really watch, though, just to keep it simple, is going to be HYG. It's old, reliable. And HYG here, we looked at this last week together, and we'll look at it again. And probably we'll have to continue looking at it each week. But I actually have this up as an internal on my intraday charts. And I just watch HYG to see if the market is doing the same thing, right? Because if tech is going to go wild and go crazy and go up 3% every day, but literally nothing else is confirming that, and then HYG refuses to confirm it, that is something that cannot persist. Eventually, either every part of the market that we care about is right, or tech is right, but they both can't be right at the same time. Not for an extended amount of time, right? So HYG here, I invite you to put this up as an internal on your charts and watch it intraday. And let's just look at the weekly chart. It's really horrible. You have a 50 sloping down very hard. That's going to be very difficult to break because of the angle. The angle is very sharp. So that's bearish, fully bearish structure. The squeeze is forming in a bearish fashion. This is completely bearish, where both lines are below 50 and the red is on top of the green. And then again, you have the worst signal possible here, which is the mid-level sell. Same thing on the daily chart, nothing but sell signals, bearish, and a squeeze. So basically, if the market tries to go up and this chart does not go up with it, you can't really believe the market. This chart's going to have a much easier time kind of taking out these lows here and kind of going back to like 71 than it will going higher. Now, if you start to see the market go up and HYG goes up with it, well, at that point, it's a lot more believable. So, little trick of the trade there that I think you'll find useful. Next week is Powell. So, I don't know what he can say that can change things necessarily. I expect him to raise 25 bips. I think the market does as well. If he raises 50, you might want to short everything, including tech. If he cuts, counterintuitively, you actually do want to short the market. That's actually not a good thing. But the only thing that I care to be long here is going to be tech, and everything else pretty much resoundingly is telling us it's all a short. So we'll see what happens over the weekend. As always, during these moments in time, this stuff can happen really quickly, right? Just 2 weeks ago, Powell was talking about raising to 50 because inflation was so high and the economy was so good. And then a week later, banks start crashing. So things are very fluid. I think I'll tell you guys the same thing I told the folks in the gold room. If you're uncomfortable with day trading or you just don't feel very proficient in it, I would certainly start to sharpen your skills with day trading because you're getting so much movement intraday. You're getting 60, 70, 80 point moves in the SPY or in the SPX daily, and these come off a 1 minute signal, right? So if you're trying to swing trade that long or short, it can be a little bit annoying, right? Because it moves up 80, down 80, and then nothing has happened. But if you're looking at it from a day trading perspective, that's opportunity on both sides. So always try to put as much edge in your favor, and until volatility chills out, day trading might be the best way to put opportunity in your favor. All right, guys, that is my time. As always, before you go somewhere else on the YouTube and you watch some naughty dog or some naughty cat doing bad things, leave us a like. Leave us a comment as well. It does help us with the algorithm. Let us know what is your beverage of choice for tonight in front of Powell. And if you don't happen to have a beverage of choice, let us know how you like your steaks. I'm more of a medium rare kind of guy. So that just helps us out with the algorithms. Lets them know that you like our stuff, and overall is a good thing for all of us. So appreciate you guys. Have a great Friday, great weekend, and I'll catch you next Friday. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.